The quiet hum of uncertainty often accompanies our journey through the market, doesn't it? That lingering question, even when we follow the well-trodden paths, asking if we are truly seeing the full landscape. You've likely felt the weight of conflicting information, the frustration of trying to translate complex theories into actionable, profitable steps, and perhaps the deep-seated fear of making a costly mistake that could jeopardize the very future you are meticulously building. It's a pain that settles deep, a silent longing for clarity amidst the noise, a desire to connect with the genuine mechanisms of wealth. Portfolio rebalancing. It stands as a foundational pillar in the architecture of sustainable wealth, a concept woven into the fabric of prudent investing. We are taught its importance, its role in managing risk, in maintaining a steady course. Yet, for many, it remains a mechanical exercise, a checklist item performed without truly understanding its deep occurrence. What if this seemingly simple act, this safeguard for your principal, holds hidden complexities that conventional advice often glosses over? What if, in our diligent efforts to rebalance, we are missing the profound strategic opportunities that lie beneath the surface? We're here to challenge that pervasive, simplistic notion. We are here to demystify, to peel back the layers of common financial wisdom and reveal the powerful, often overlooked truths that transform rebalancing from a chore into a profound strategic advantage. This isn't about mere adjustments, it's about understanding the pulse of your portfolio, the rhythm of the market, and your own deepest intentions for wealth. As Benjamin Graham, the sagacious guide of value investing, once taught us, an investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. This profound truth extends far beyond the initial selection of an asset. It demands that every ongoing action, every decision to rebalance, be rooted in that same thorough analysis. Are we truly engaging in an operation of thoughtful investment, or are we, perhaps unwittingly, drifting into speculative adjustments under the guise of safety? We are uncovering the hidden truths behind wealth accumulation, ensuring every move you make is an informed, deliberate step toward true financial mastery. Don't just invest, understand the why behind every decision. There's a quiet ache many investors carry, a secret struggle against the very logic they know to be sound. You feel it when a cherished asset, one that has climbed steadily, whispers to you not to let go, even when its weight in your portfolio has grown unwieldy. Or perhaps it's the stubborn refusal to divest from a declining position, a hope-filled anchor dragging at your returns, because selling would mean conceding a loss. This isn't a failure of intellect, it's the profound, often unseen, battle against emotional attachment and aversion, an investor's Achilles heel that quietly sabotages objective rebalancing and deepens that feeling of financial inadequacy. We often cling to the comforting illusion that a set-it-and-forget-it rebalancing strategy automatically bypasses the intricate dance of human psychology. Yet, beneath this mechanical veneer, deep-seated cognitive biases actively work to undermine disciplined execution. It's a subtle current, pulling us away from our stated goals. When an asset soars, our brains release a gentle wave of dopamine, confirming our wisdom, making us hesitant to trim its sails. Conversely, a falling asset can trigger cortisol, activating our loss aversion, making us cling tighter, hoping for a recovery that might never come. This emotional tug-of-war subtly transforms rebalancing from a strategic adjustment into an unwitting act of market timing, often at the least opportune moments. To navigate this inner landscape, we can conduct a quiet, three-step behavioral audit for your rebalancing process, drawing from the profound insights into human judgment offered by minds like Daniel Kahneman. First, before any rebalancing decision, pause and acknowledge the feeling associated with each asset, the pride, the fear, the regret. Second, articulate the objective, data-driven reason for the proposed adjustment, separating it from the emotional narrative. Third, imagine this decision was made by a trusted, unemotional advisor. Would you still agree? This practice helps neutralize emotional sabotage, empowering you to make truly objective portfolio adjustments. Rebalancing is not merely adjusting weights on a spreadsheet. It's a wrestling match with the ghost of your past decisions, where true victory lies in disciplined detachment and the mastery of self over market noise. We are uncovering the hidden truths behind wealth accumulation, inviting you to understand the why behind every decision. There's a subtle, almost unacknowledged erosion that can silently chip away at the very compounded returns you've worked so hard to build. It's a feeling that something is amiss, a silent fear of financial loss, even when you believe you are following prudent advice. We often overlook the hidden transaction costs, the tax inefficiencies, and the insidious opportunity cost that can accompany a forced sale during rebalancing. These aren't just minor deductions, they are invisible wealth shredders, quietly diminishing your long-term accumulation. The widespread distortion is that rebalancing is a free or low-cost activity. We might account for explicit trading commissions, but what about the continuous drag of bid-ask spreads? Those tiny differences between what a bear is is willing to pay and a seller is willing to accept. More profoundly, we often ignore the far greater impact of taxes on realized gains. Each time you sell an appreciated asset to bring your portfolio back into balance, you might be triggering a taxable event, effectively paying a toll on your journey toward financial independence. This is why frequent or untax-optimized rebalancing, though seemingly disciplined and logical, can paradoxically reduce your net long-term returns. It shatters the expectation of pure efficiency. By constantly trimming winners or adding to losers without a strategic eye on the tax implications, you sacrifice the incredible power of compounding. You interrupt the exponential growth of your capital, forcing it to restart from a lower base after taxes, triggering avoidable events that steal from your future self. To truly master this, we must adopt a forensic accounting approach to calculate the true all-in cost of your rebalancing strategy. This involves not just tallying commissions, but integrating tax loss harvesting where appropriate and adopting a truly tax-aware rebalancing framework. It's about making every allocation efficient, every adjustment a thoughtful act of capital preservation and growth. Rebalancing without a rigorous cost analysis is like attempting to fill a bucket with a hole in the bottom. The effort is there, but the underlying structure continues to bleed value unnoticed, subtly undermining your wealth accumulation. We're uncovering the hidden truths behind wealth accumulation, inviting you to understand the why behind every decision. Do you ever feel that knot of anxiety when a pre-scheduled rebalancing date looms, especially when the market is a tempest of volatility? It's a profound sense of investment inadequacy, a discomfort that arises from being forced to act, to sell, or buy precisely when your gut tells you to pause, to observe. This rigid, time-based approach often leads to suboptimal outcomes, leaving you with that nagging question: was this truly the wisest move? The common distortion is that annual or semi-annual rebalancing is universally optimal. It's boilerplate advice, a comforting rhythm, but one that regrettably disregards the very dynamic nature of market volatility and the specific drift thresholds of your own portfolio. The market doesn't operate on a calendar. It moves in waves, sometimes gentle, sometimes turbulent, and a fixed schedule can force you into action at the least opportune moments, like trying to catch a train that has already left the station. Data, the unwavering voice of truth, reveals a different path. A rules-based, threshold-driven rebalancing strategy often demonstrably outperforms fixed schedule approaches. It minimizes unnecessary trades, reducing those invisible wealth shredders we spoke of, and crucially, it capitalizes on significant deviations, allowing you to act when it truly matters, rather than just because the date arrived. This shatters the myth of calendar-based superiority, inviting you to engage with the market's true signals. Consider a three-step framework for implementing a dynamic, volatility-adjusted rebalancing trigger system, drawing from the deep wellspring of quantitative risk management principles. First, establish clear percentage bands around your target asset allocations. For instance, if an asset class deviates by more than 5% or 10% from its target. Second, define specific market volatility indicators that would either pause or accelerate your rebalancing review. Third, integrate these triggers into a disciplined, automated review process, removing the emotional guesswork. This transforms uncertainty into a strategic advantage, optimizing timing and reducing portfolio drag. Blindly rebalancing on a calendar date is like trying to navigate a tempest by the clock rather than by the storm's intensity. True mastery lies in responding to the market's signals, not just the passage of time, embodying the principles of adaptive risk management. We are uncovering the hidden truths behind wealth accumulation. Challenge the consensus. Find your edge. There's a deep frustration that settles in when you diligently rebalance, only to find yourself constantly fighting the tide. You pour capital into assets that seem stubbornly intent on underperforming, especially when the market itself feels like it has fundamentally shifted. This feeling of being outmaneuvered, a quiet exasperation, can erode trust in the very traditional financial advice you once relied upon. You follow the rules, yet the outcome feels like a betrayal of your effort. The pervasive distortion suggests that strict rebalancing always reduces risk and enhances returns, a comforting blanket thrown over all market conditions. But what happens when the underlying currents change? When a structural shift in market leadership or fundamental economic conditions renders your old assumptions obsolete? To blindly adhere to a rebalancing schedule in such times is to ignore the very essence of market dynamics, to pretend the world hasn't changed its tune. Indeed, rebalancing can become a return-smoothing tax on growth during sustained bull markets in specific sectors or assets. Imagine an emerging giant, an innovation poised for a decade of dominance. Strict rebalancing would demand you liquidate portions of this winner, forcing you to sell what is still in the early stages of a new, powerful regime. This shatters the expectation of universal benefit, revealing revealing how an unthinking application of a good principle can ironically hinder your wealth accumulation, preventing compounding magic from truly unfolding. This calls for a regime-aware rebalancing overlay, a more sophisticated approach. It involves integrating macroeconomic indicators and momentum signals into your rebalancing decisions, allowing for strategic pauses or critical adjustments to traditional rebalancing during identified market shifts. This approach is grounded in a deep critique of the efficient market hypothesis, recognizing that markets are not always perfectly efficient and that understanding underlying economic cycles can offer a significant edge. It's about listening to the deeper rhythm of the economy and adapting your sails accordingly. Rebalancing in a new market regime without adaptation is like trying to sail a course set for fair weather into a hurricane. The tools you possess might be the right ones, but the context demands a complete re-evaluation of the journey. True mastery lies in embracing the critical importance of macroeconomic analysis, allowing it to inform your rebalancing, rather than letting a rigid schedule dictate your fate. We're uncovering the hidden truths behind wealth accumulation, challenging the consensus to help you find your true edge. There's a quiet feeling of inadequacy that can arise when generic portfolio rebalancing advice clashes with the nuanced realities of your own life. You might be a young entrepreneur with immense human capital, or a seasoned professional nearing retirement with stable income. To apply the same rebalancing rules to both, ignoring the profound differences in career stage, income stability, and unquantified human capital assets, feels like trying to wear a suit that doesn't quite fit. The advice isn't wrong, but it's not your asterisk truth. This fosters a pervasive myth that a standard asset allocation, and thus standard rebalancing, is equally effective for everyone. It's a distortion of true portfolio diversification to suggest that what serves a young tech entrepreneur is the same as what suits a nearing retirement physician. Your financial blueprint is as unique as your fingerprint, and your rebalancing strategy must reflect that individuality, not a generalized template. Consider this profound truth. Your most significant asset, your human capital, your future earning potential, your skills, your career stability profoundly impacts your true risk tolerance and rebalancing needs. It often necessitates a counterintuitive approach to traditional asset allocation percentages. A young professional with decades of earning potential might, for example, be able to take on more risk in their financial portfolio. This shatters the one-size-fits-all expectation, demanding a deeper, more personal understanding of your wealth. To move beyond mere age-based rules, we need a qualitative and quantitative framework for integrating human capital and specific life goals into a dynamic, personalized rebalancing strategy. Assess your career risk. Is your industry stable or prone to rapid disruption? What are your future income projections? How do your major life goals, a new business, a child's education, a specific retirement dream shape your immediate liquidity needs and long-term capital requirements? This holistic approach ensures your rebalancing isn't just about numbers, but about aligning your financial decisions with the very essence of your life's aspirations. Your investment portfolio is merely one limb of your financial body. True rebalancing harmonizes its movements with the strength and vulnerability of your career, your aspirations, and your unique economic ecosystem. It creates a symphony of strategic finance where every part works in concert rather than in isolation. Is your diversified portfolio truly diversified, accounting for your most valuable asset? We are uncovering the hidden truths behind wealth accumulation, inviting you to understand the why behind every decision. We've journeyed through the often unseen currents beneath the surface of portfolio rebalancing, haven't we? That initial feeling of being overwhelmed by conflicting information, the quiet anxiety of making costly mistakes, the struggle to translate theory into tangible wealth, these are valid pains. We've unraveled how rebalancing is far more than a rote, mechanical task. It is a nuanced dance with our own market psychology, a careful navigation of hidden costs, a responsive adaptation to dynamic market conditions, and ultimately a profound alignment with our deeply personal objectives and human capital. True mastery of rebalancing, then, lies not in blind adherence to generic rules, but in understanding these hidden truths. It's about moving decisively beyond boilerplate advice to embrace a strategic, data-driven, and personally tailored approach. It's about recognizing that the market is not a static canvas, but a living, breathing entity, and your portfolio must breathe with it, informed by a deeper wisdom. This journey encourages you to adopt a critical, analytical mindset, transforming your rebalancing from a reactive chore into a proactive, powerful tool for sustainable wealth accumulation. It's about cultivating a discerning eye, one that questions the obvious and seeks the underlying mechanisms. As Warren Buffett famously stated, the most important thing to do if you find yourself in a hole is to stop digging. For rebalancing, this means stopping the blind application of generic rules and starting to dig for the deeper, data-driven truths that actually build enduring wealth. It's a call to pause, to reflect, and to re-engage with your financial path with renewed renewed clarity. Consider your portfolio not just as a collection of assets, but as a living reflection of your strategic intent. Take a quiet moment with a deep breath and feel the weight of this understanding. Let the insights we've shared settle within you, inviting you to observe your own tendencies, to analyze your statements with fresh eyes, and to listen to the subtle whispers of the market. This is the practice of true financial introspection. Are you prepared to transform your rebalancing from a mere obligation into a masterpiece of strategic discipline, truly aligned with your deepest aspirations for financial independence and sustainable wealth?